Alright, good afternoon, everybody. How's it going? What's up? What's up? What's up? Great seeing everybody. Like always, great seeing everybody. There's no conversations with the pro trader today. I think Greta's on vacation. I think that resumes again next week. So, our usual afternoon meeting is what we'll do. We start with the disclosure. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. My position disclosure is the same as yesterday, except I have some Tilray. I talked about in the morning meeting. I can go over it again briefly this afternoon if you guys want. All right. Excuse me. Popping over the charts. So, how do we close today? An update where we actually closed on or about on highs. Is it productive for the bulls? We'll see. We'll take a look at the big picture chart to try to dissect that. But the SPYs are up 0.66%. Qs are up 1.3%. And this IWM, come on, you gotta be kidding me with this red IWM. Flat red, but still red. On a day when we actually snapped back, that I'm trying to make an argument is productive for bulls. But let's take a look at these daily charts to see. So first of all, inside day for the SPYs and Qs, not for the IWM, which technically gave an RDR. SPYs here, again, inside day. Today was a tricky day. I see Demetrius comment out of the corner of my eye. Between the pre-market price action to where we opened and how we traded off the open versus how we closed was a tricky session. I'll go back to the 5-minute chart in a second. But inside day for the SPYs, inside day for the Qs. I mean, these Qs, if you're just looking at the NASDAQ in a vacuum and not looking at RSP or IWM or to some degree even the SPYs, these Qs look very neutral. You know, we've spoken about how the intermediate time frame trend for the SPYs has also started to become bearish as we're coming into big picture support, but the intermediate time frames also started to become bearish. That is not true for the Qs. It's hard to even make an argument that the Qs on the small time frame are bearish. And you won't be able to make that argument at all if the Qs can get back above basically 363, 362.95. If they get back above there, then small time frame is neutral to bullish. Intermediate time frame is neutral, big time frame is bullish. And without doing that, I would say the small time frame is still pretty neutral, intermediate time frame is neutral, and big time frame is bullish. So, I mean, these Qs look good. I mean, they're building out a base that you would want to buy. But we can't look at the Qs in a vacuum because that would ignore the other 495 S&P companies or 493 S&P companies that are out there. The IWM, a little bit more representative of your average stock that's out there, along with taking a look at the RSP. I was really disappointed in this Russell weakness this morning. I was frustrated by it. You guys might have been able to tell just with how I was talking in the VTF this morning. I was really frustrated by this weakness in the IWM. The beginning part of the day in particular I thought was really tricky. At the end of the day, though, still with relative weakness, SPYs and Qs gave inside days and closed positive. Qs closed up a lot. The IWM is red here, but you can't look at this chart in a vacuum and say that it's not at least productive as of the close. Still don't like the relative weakness, but you know, day 4 tail on okay volume, closing back through the previous day's low and pretty much pretty much near highs into the close for the market. Let's shoot over to the small time frame charts and look at the small time frame. The story really starts with the pre-market today. When I woke up this morning and first logged into my computer, we were red. And I remember I got a great buy in Microsoft pre-market. I bought 312. This might even be my tick here. 650 in the morning. What's this low? 312. Couple hundred shares. Yeah, I think that's my tick. So pre-market when I first woke up, we were we were set to gap down, and then we went into this upside grind at about 7 o'clock in the morning. And Chris, I remember you mentioning that there was some commentary out of someone, I really don't remember, that helped create this bid in the TLT, really, starting at 7 a.m., which helped give the market a boost as well. I don't remember what you said about it. Oh, Steve Leisman on CNBC said something. Okay, well, TLT gave a great uptick starting at 7 a.m. It boosted these SPYs, it boosted the Qs, boosted the IWM to a lesser degree. Then we had our number hit at 8:15. It's not the important employment number. That's going to come out on Friday. It was this ADP, is I think what hit today. It's not nearly as market moving as Friday's number is. It did come in really light. So someone here in the VTF, I think rightly so, said, like, hey, does this help to negate some of the negative information that came from JOLTS? And I would say yes, but with like a big grain of salt or a big asterisk around it, because I think the ADP number is not nearly as market moving as the number we have on Friday, which I think is non-farm payrolls. So yeah, I mean, beneficial sure at 8:15. We got a little bit of an uptick here in the market, but I wouldn't overread that number. We got to see what happens on Friday. So by the time the market opened, though, we were actually at that point set for a gap up, which changed the picture a little bit. What we all wanted and what we talked about in yesterday's afternoon meeting was we'd love a gap down to below 420. You know, it'd be a big gap down. It would make the market be finally, you know, getting more extended away from that ADMA again, but it'd be a big gap down into this huge support zone that we're looking at with the IWM gapping down on a day 4, and that would be something that we could look to be a little bit more aggressive with buying. But again, we didn't get that because of that uptick in the TLT pre-market. The market upticked as well. We got this up open, and you know the up open is hard, and that's what we discussed. Because on the one hand, there is certainly room for this market to stay bearish on the small time frame and bounce further. Like the bears can still be right, and you can absolutely have a couple up days in a row that gets this market back to 427, 428, 429 for some sort of pivot high, and then we'll see if supply comes in there and pushes this market back down. So opening up at 422, it's like, all right, you know, we're getting this gap up. I don't think you could short this, but buying it here when the market's been so weak is also kind of difficult. All the same, the opening price action was productive, and this is what I wanted to see. I wanted to see the opening price action. I wanted to see how the market handled this small, it wasn't big, this small gap. We figured that would get satisfied with these moving averages and that equilibrium on the small time frame very quickly, and then we can see what the market looks like. So you can see at 945, 950, the ADMA is caught up. We're trying to create a pivot low here for the market. We're trying to turn up. And if we could make this higher low that leads to a higher high post 10 a.m., then all of a sudden, you know, we're going to be looking pretty good for the SPYs. The Qs are a similar story. Gap up, initial move higher, digesting the 5-minute extension through time, going sideways, basically building a bull flag. ADMA is catching up. You get this quick little shakeout tail for people that trade on like 2-minute charts or who are overly momentum focused. I love this candle when it happens in bull flags. It's usually a great signal for continuation, by the way. You get this bull flag that's building out. People start to recognize it. People start to buy it, but they're too early. Equilibrium hasn't caught up yet. What do we know? When equilibrium hasn't caught up to a pattern like a flag pattern, there's a higher probability that the low of that shakes out. And actually the low of that shaking out, if it's a tail, like with this 950 candle, actually makes it even easier for the market to move higher. Because some of the small time frame, real momentum bullish traders get kind of shaken out of the market a little bit. And maybe some shorts who are trying to stay bearish on the market get back in. And now it just makes it even easier for the market to move higher. And that's coupled with this inside 5. The ADMA is still catching up. Like, this is looking really productive into 10 a.m. The IWM is the headache. Immediately weak. This first 5-minute bar, I mean, you know, look what the Qs are doing on the first 5-minute bar. Look what the IWM is doing on the first 5-minute bar. And I'm like, okay, you know, first 10 minutes of the day when I'm looking at the Russell, I'm like, relatively weak, but holding around flat, not the end of the world. It could break up. Yeah. SPYs are breaking up, Qs are breaking up, IWM could break up. And, you know, I didn't trade any of them, but I'm looking at some of these consumer staples. I'm looking at Target. I ended up trading the IWM itself a little bit. I actually made money in that trade, but it was not an easy trade. I bought it a little bit later than that. But it's like, okay, you know, could go in either way. And then this 940 candle, when the market's still holding in, was just atrocious. And now I'm back in this scenario that's very familiar to us from the last few years, where I've got SPYs looking okay, you know, a little bit of a pullback on this 940 candle, but it's a pullback from extension that's enabling it to create a potential higher low. I got the Qs here. Also gave a red candle at 940, but it's just an inside candle digesting through time this really good strength. And the IWM just like breaking down and showing weakness. And then it's like by the third bar that comes in, I'm like, all right, you know, this Qs still look good, the SPYs still look good. This IWM could just give an RDR here, you know, quick pivot through yesterday's low, snap back some relative weakness, and then regain some strength. And this is when I actually started trading, initially lightly, the IWM via the TNA. And, you know, I'm looking at some of these other names I'm trying to be involved in, and the Qs are up so much. And again, it's a similar playbook for me where it's like, yeah, you know, I'm long Amazon, I'm long Apple, I'm long Microsoft, I'm long some of these names that are the beneficiaries of this relative strength and that are paying me. But I'm like so focused on the fact that I've got also 5 stocks that are red on the day and that are weak and that are trading a little bit more with this IWM, and that ends up taking, like, you know, it's probably a bad habit. I tend to overly focus on the positions that I'm in that are not paying me, as opposed to the positions that kind of are paying me. And I just felt like, given what the Qs are doing, given what the SPYs are doing, his breath is super poor again, and it's just big cap tech. And at a certain point, I was like, you know what? I gotta ignore these weak names a little bit. See you, Josh. Sure. Thanks, Josh. See you. Everyone, I'll talk to you next week. See you in a few weeks. I'm like, I need to be looking at these big cap tech stocks, and that's when I looked at Microsoft, which I'm in, and I was like, Microsoft looks like a long through 316.50. We called that out, and eventually that broke up and went because that's where the strength was. We looked at Apple, which got downgraded and had an insider sell, so it was relatively weak, but snapped back to green. You know, the name got downgraded and had a big insider sell, and it's still stronger than any name in the IWM, which is insane. But about the same time of the day, basically looking at highs, 162.75. That could be a buy spot if we break higher. This one was harder. It probably shook out. Or what was the other one? Amazon, I think, was the other one. You know, like these are the longs and the relatively strong stocks. Like, this is the better trading. Or DraftKings, which I took a little trade in this initial flag, but the market pushed me out. I think Rose here in the VTF was able to stick with it or rebuy it or something, and was able to kind of make some money. But this is the stuff you want to be focusing on. You know, I know some of us were involved in these banks, and you know, it's just a harder trade. The IW, or buying the IWM itself, it's a harder trade. Or any of these other names that were just weak within that complex. Some of the growth names are strong, some of the growth names are weak. I mean, even Palantir, as difficult as Palantir was, and this was one of my ideas for today, you're better off trying to focus on this Palantir in this area at 10 a.m. or 9:45 or whatever. Granted, it was a little bit extended at a certain point, than trying to focus on the weak stuff. It's just where the easier money is. And then just when I'm looking at the SPYs trying to hold in, the Qs trying to hold in, and the IWM weakness, but thinking maybe this IWM can round up and actually catch up with the SPYs and Qs, which is probably the wrong thinking, because usually it's the opposite that happens. We get, I think it was that ISM PMI number hit at 10 a.m., which to me I felt looked very neutral, but the market's immediate reaction to it was down. So now you got the SPYs losing opening lows, losing equilibrium, overshooting the gap fill, creating what I would call a penalty box candle that makes the market guilty on the small time frame at 10 a.m. The Qs, which were strongest, eventually break their opening low. Granted, they kind of held equilibrium, but I would argue that they overshot. And then if this low wasn't too difficult for you to hold your stock through, this low certainly was at 10.25 when that low breaks again before this market actually began to move higher. And the IWM is just continuing to grind down. It made for a very, very difficult open, I felt. And then what happens? The rest of the day is really sloppy, as inside days tend to be. Spies and Qs are really sloppy. And one thing that I noted when I was still on the radio was I wouldn't be surprised if we saw supportive flows come in the afternoon again. And this just goes back to that same 0 DTE dynamic of the 0 DTE options that are being sold in the beginning of the day have to be covered into the close, and then the market makers on the other side buying back equity to rehedge those positions. It tends to be an afternoon dynamic. It tends to be an into the close dynamic to some degree. And that was kind of the last thing that I really noted on this market, and that's eventually what happened. But the intraday trading today, I thought was difficult from an index perspective. Difficult if you focused on the wrong names, and honestly difficult even if you focused on the right names. But there was easier money to go after out there today for sure. There was harder money to go after there for sure. And you're better off going after the Microsoft or the Meta or the Tesla. Rex was all over that Tesla, by the way. Great job, Rex. When I first looked at the daily chart, and I haven't been trading Tesla recently, so I know the names better from trading them for sure. I think that's the same way for everybody. So I first looked at Tesla in the morning meeting. I was like, Tesla's an inside day yesterday, but it's an inside day within a consolidation. I think it's sloppy. And then Rex was like, yeah, but that inside day is because the stock was relatively strong. Everything else, look what the Qs did. Qs didn't give an inside day. Yesterday, the Qs broke down. Tesla was able to give an inside day. That's relative strength. So I like Tesla off that relative strength if it's able to break through 250. It sounded like, Rex, I don't know where you got involved. It sounded like you got a jump start on that. Probably saw this opening strength, opening volume, got a jump start on it. The 250 by itself was difficult because you had just ripped $2.50 into it. It would have been a lot of risk versus lows. But then beautiful bull flag when the market had this pull in at 10 a.m. This was just a pullback into equilibrium, and then this was another one with that break higher at the same time as the Microsoft and the Apple and the Amazon. Tesla was the best one for a new buy here through 253, which is great continuation. Just the stock, just incredibly strong there. So that is, I guess, kind of a synopsis of the day. Trying to think about anything else that I really wanted to go over. I don't think I do. Aspects of the day were frustrating for sure, especially at the open with the poor breadth, weakness in the IWM, weakness in some of the stocks that were out there. I really thought, and part of the reason for my frustration this morning, especially as we broke down at 10 a.m., was that I really thought with what the TLT did pre-market and off the open, and what the dollar did pre-market and where it opened, that this entire market would be stronger today. And I actually thought that a lot of that strength would come into the IWM. I know interest rates going down is going to be technically better for big cap tech, but big cap tech has held in so well as like a safety play that I really thought with this TLT move pre-market and with where we opened that it would benefit some of these IWM names, recognizing that XLE was getting smoked off of USO, and that has an effect on the IWM. There's a lot of mid-cap energy names that I think are found within the Russell 2000 that probably weighed on this index a little bit more. But I didn't focus on energy today because I recognized that this gap down was breaking the chart in the XLE and was breaking the chart in USO. And sure, I still do have a Chevron position that I'm going to manage, though I sold it. I sold a majority of that position at 170 that I had, and now I bought back a little bit small into this down move, just per my game plan of kind of rebuying back into dips as I sell into those rips, and but I wasn't focused on energy. I stayed away from it, and even with that, and even with TLT up, it seemed like there were just so many names out there. Obviously energy, but whether the banks and a lot of growth that was just not trading well today at all. And then, of course, the market had a strong close. So at the end of the day, I would describe it as a productive day for the bulls. You could also certainly make the argument that this is just a bearish consolidation day. It's an inside day within a bear trend for the SPYs and the Qs. So I think that this inside day is actually pivotal in how it resolves itself over the next 2 days. Obviously, tomorrow is usually when the inside day will break, but I'm saying 2 days because we have a really important jobs number on Friday. Because it's an inside day within a small time frame downtrend. This is technically bearish, but it's an inside day right in front of major daily support in a big time frame that's still bullish. So this thing could break either way. You could make the argument on either side for sure, and I do think that which way this market resolves this inside day over the course of the next couple of days, which will probably happen in conjunction with how the TLT and how the dollar moves, is extremely important here if bulls want to attempt to take some control back on the small time frame in this market. That's all I got. I'm happy to take a look at your guys' question. All right, so first question here from Rose. Hey, Derek, so going over my trade in DraftKings, I have 2 questions about it. Sure. So first of all, shout out to Rose here. If I gave out like an MVP of the VTF award each day, you would be the one that gets the award, because you're still, I hope you don't mind me saying, a newer trader, newer to the team. I think newer in general to professional trading, and I know you always say hi and everything in the morning meeting, but you, I think, stepped out of your comfort zone a little bit more today to communicate the trades that you were looking at before you got into them for feedback, which also potentially helps your traders around you to have more ideas. And now you're asking follow-up questions about it here after the close, and just to use Rex as an example, also, who I've mentioned many times in the past. For anyone else who's out there who is a shy new trader, because I know there's a bunch of you out there, this is how you get better. You get better by asking questions. You get better by communicating your trades in real time. If anybody is out there and they're struggling as a trader, but you don't ever say, hey, I'm looking at DraftKings, I think I might buy this bull flag, what do you think? Well, no one's going to be able to help you because you're not communicating your trades before you get into them. So, first of all, just kind of a compliment there, and now, let's get into your question. So, at 10.12, I bought a couple hundred shares of DraftKings at 28.46 with my stop loss at 28.24. I'm just seeing when I got involved in this. I got involved in a little bit before you. Okay, so at 10.12, so in this candle, this inside 5, you bought a 28.46 at 10.12. If your number is correct there, 28.46, you bought above the high of that bar. So I think your price might be slightly off there, or your time. 10.12, right? I'm at the right time? Yeah. Stop loss at 28.24. Okay, that makes perfect sense. It's just the low of this consolidation, low of this flag. My risk was covered at 46 cents. Okay, so your entry price was below that. My risk was covered at 28.46, presumably on this bar here at 10.30. Okay, your entry price was 28.35, so you got 11 cents worth of risk. Where are you selling? 11 cents worth of reward, 28.46, presumably on this 10.30 candle. That's where you're getting your risk covered. Great. I was stopped out of the trade at 12.08. Okay, on this bar. After I moved up my stop loss to 28.48, which I'm going to presume is the low of the 10.55 candle. 28.51 is the low of the 10.55 candle. Why did you move your stop loss to 28.48? Is my next question for you. How did you choose that price? Price hadn't actually touched the ADMA on the 15-minute chart. Maybe you're trading off a 15-minute chart. Still the low is 51. By 12.08, the ADMA is above that price, but maybe you moved it ahead of the ADMA on the 15-minute chart getting there. But it was well above where I was moving my stop loss. Yes, that's fine. The price doesn't have to touch the ADMA you want the ADMA above your stop loss. That's exactly right. Move my stop loss. So in my head, I was feeling like what I was doing was okay. Yes, the price doesn't have to touch the moving average per my trailing rules. The price of the stop loss has to be, in this case, because it's a long, the ADMA are lower. So I want the ADMA to catch that, to be at 20, if you're using 28.48, I want the ADMA to be at 28.48 or above in order for me to raise my stop. Price action doesn't have to touch it. So that's perfect. The only thing that I would say is the stop loss itself. The low of the 1045 bar on the 15-minute chart, if that's what you're using as your pivot, slash the low of the pullback, the low of the pivot low on the 5-minute bar, they're the same price, are 28.51. So if it was my trade, I'd be using 28.50 as the stop, not 28.48, 1 penny below the low of the pivot. Because remember, the trailing rules are pivot low, ADMA catch up to the pivot, not the price action, to the pivot. So pivot low, ADMA catch up, and new high. So what do you have here, right? You have your bullish consolidation. The stock breaks up. It has a technical pullback into the ADMA. Just looking at the 5-minute chart, we can do the same thing on the 15-minute chart. This pulls back into the ADMA area below it on the 5-minute, gives you a pivot, and then a new high comes in at 11:15. So at 11:15, as far as time goes, that would be the time in which I could feel comfortable if I was trying on a 5-minute, I know you're trying on a 15, to raise my stop to this price and then continue to trail. And that's what you did, and it's fine. Whoops. If we go over to the 15-minute chart, wherever my charts went, if we go over to the 15-minute chart, it's a little bit less of a pivot, but you get this great continuation off of this 15-minute chart, like descending bull flag that ends with an inside 15 as the ADMA catches up, shoots higher. It's hard to. This is one of those kind of iffy pivots, honestly. The low of this 1045 bar on the 15. You could use it as a stop loss. I'm not gonna say it's wrong, but it's not like a clear pivot low like this is a clear pivot low, right? But all the same, if you choose to use it, fine. So when can I raise my stop to this low? Well, this is my pivot, fine, that's done. My new high comes in at 11:15. At what time does the ADMA get above this pivot low of 28.51? It gets above it. This is 28.50 on this bar, technically on this bar, on the 11:30 bar. So on the 15-minute chart, it's at 11:30, at the 11:30 bar, that technically it satisfies all my rules to raise your stop to this pivot. And then, for whatever reason, you get a big downtick here at noon that takes out your trailing stop. All of that is perfect. The only other thing I would mention is that if you trail your entire position tightly, sometimes you get shaken out of stock. But otherwise, if you've got a larger position, I know you didn't have a very large position. If you had a larger position, you can afford to trail some of it the way you did, and some of it, you know, still giving it back to that initial low or waiting for like a more decisive pivot on the 15 to raise on. Sometimes it saves you the aggravation. Sometimes it means you end up giving back even more profit. But honestly, you trailed on a 15-minute chart, and that's awesome. Usually the problems of getting shaken out happen because people trail on a 5. And 5-minute trailing stops almost always break if you're trailing really tightly on a 5-minute chart by midday. The 15-minute chart, that's not as true as often. The 15-minute chart tends to hold much more throughout that midday period, and if we're in a strong market environment, it could hold throughout that midday period and then close well, and then you end up swinging it. So I think that you traded this perfectly. Let me read your second question. When you take a position as a feeler, do you size up when the stock breaks through a certain point? For example, my trade in DraftKings today, the second time I took the trade, I took it very small because I wanted it to prove itself first. Would you have added to the position when it broke above 28.55? 235, which is the highest part of that initial consolidation, probably the highest part of the 15-minute consolidation. And if so, I know I would still have to use my original stop loss at 28.24 for your stop. Yeah, for everything now. I would be adding, and I'd be taking on 32 cents of additional risk on those shares. So on the way to get that risk covered, would you have sold some of your original position? Hopefully that makes sense. And if you want to tell me how you would add and trim throughout the trade, that'd be helpful too. Sure. So would I add on the break of the flag? The answer is definitely a maybe. It depends on my conviction on how the market's trading, how my conviction on how the stock is trading, and it depends on the amount of space risk I have to take on the ad. And that's the hardest part. It's that 32 cents that you're talking about of additional space risk that you're taking on an ad. Because on your actual stock that you have, that you bought at a cheaper price within the consolidation, by that point you could be getting, you are in fact getting your risk covered. And now you're talking about adding even above that. So the answer is not a great answer, but it's a truthful answer. When I say maybe, I might take the ad, I might not. And then if I do take the ad, how do I treat it? Is kind of this part of your question also. Meaning, do I treat it based on my average price on this trade because you're averaging up on the trade, and like you're taking some extra stock there with 32 cents risk, but your average price is going to be a little bit below that. So maybe off your average price, you've got 25 cents worth of risk. I'm just making up numbers instead of 32 cents. Or, and if you have 200 shares from the first buy, you got 200 shares from the second buy, something like that. So now you got 400 shares from an average price of 25 cents. You could do it that way, or you could treat them as two separate trades. And this is another thing where I don't think either answer is wrong. You could treat it like I've got one trade from, I think you said 28.35, and I've got the second trade from 28.55. My first trade has 11 cents worth of risk. My second trade has 32 cents worth of risk, and treat them separately. So you're still you're still selling your first piece of the cheaper buy 11 cents in the money, and then you're still selling your second piece of your first piece of the second buy when you're 32 cents in the money. I think that's fine. I also think just saying, hey, I've got 400 shares from an average price of 22 cents risk or whatever it is, and I'm going to sell 200 shares 22 cents in the money is also fine. Neither of those are I think technically wrong. It's kind of trader preference based on the situation that you find yourself in. So I think that covers most of what you're saying, except for how would I add and trim the trade throughout the rest of the trade. The unfortunate part about trading smaller position sizes is that you don't really have the luxury to do a whole lot from a game planning perspective. And it's unfair, but it just kind of is what it is. If you, instead of buying 200 shares and 200 shares, if you're buying 2,000 shares and 2,000 shares, instead of having 200 after you sell 200 shares to get the risk covered, you still have 200 shares for your bigger move that you're trailing or whatever. The other situation is that you have you bought, what did I say, 2,000 and 2,000, so you still have 2,000 shares left for the bigger move. There's a lot more that you can do with 2,000 shares and 200 shares as opposed to taking stock away and trying to add it back for cash flow. When you only have 200 shares, there's not really much you can do. Yeah, you could take 100 shares of it and try to sell it if the stock gets really extended and rebuy it at equilibrium. Fine, I probably would do that more technically than quantitatively, which is something we've discussed in the past on how to take off and add back for cash flow. So with just 100 shares, I don't think you can do it quantitatively. And by quantitatively, I mean selling in increments. I'm going to sell, if you got 2,000 shares and you say to yourself, I'm going to sell 100 shares every 25 cents on the way up and rebuy that 100 shares every 25 cents on the way down and put an extra $25 in my pocket every time I'm able to do that, you'd be able to do that over the course of 2,000 shares for 5 points. You wouldn't run out of stock until the thing is at $34, basically. That's a lot of room to be able to kind of work quantitative increments. You can't do that when you have 200 shares. You have 100 shares that you could trade technically. All right, it just got super extended on this big move. So I'm just going to take a little bit off, and I'll look to rebuy it at the ADMA and see if I can keep a price difference. Or you can just trail it, and or you could do 1 and 1, right? You could take 100 shares and try to sell extension and rebuy at equilibrium, and you could take the other 100 shares just because you might lose it, right? You might end up losing that first 100 shares because you think you're selling it into extension, just keeps going and going and going and going. That's the risk of trying to do that methodology. In this environment, it's been better because we haven't been in a trending environment. We've been in a ranging environment. So in ranging environments, it's better to try to work those ranges for cash flow while you can. And this environment has not been a trending environment, so trailing has not been as productive. But I'm still always going to be a really big advocate of trailing with trend trades and relative strength. So again, you could try to take 100 shares and say, you know, my game plan is I'm going to trail both 200s, but one of the 200 I will sell into big extension, look to rebuy, and the other 100 I'm just going to keep trailing and trailing and trailing until it stops me out, and that'll be my reward maximization strategy. So again, this is just one of those situations where bigger account and more tier size provides a lot of benefit to a trader, and it just kind of is what it is. Because think about, like, if you had, you know, not to pound a point that you might not be able to do anything about, but if you got 2,000 shares and you're in a range-bound environment, and this thing bounces $1, but it's a range environment, so then it pulls back $1, you could sell 100 shares every 25 cents, rebuy that 100 shares every 25 cents, resell that 100 shares every 25 cents, as long as you stay within the range. You're not going to be able to do that with a smaller position size because you run out of stock. So I hope that answers all of your questions. I appreciate you putting them in there. Great job today. Great job being involved. I think it'll pay off in the long run. From Eddie Vick, fundamentally, NASDAQ and Russell divergence makes sense, ? Given high interest rate, small caps got hurt more than large companies with less debt, mostly cash. For some of the big names, the balance sheet and profitability are simply better on big tech than other sectors. Yeah, I think it does. I think it does make sense, and I think that's the argument that Goldman in some ways was trying to make a day or two ago when they posted that note, and they're trying to argue that big cap tech is cheap, especially if you factor in the growth perspective of what those companies are. The flip side of the argument, though, that you could make, which I think is what, like, Subramanian at Bank of America is making, is the PE of the average IWM name is like on a 10x multiple, you know, is a 10 multiple, and for I don't know what it is for the average big cap tech stock, but I would assume it's like 30 or 40 or something like that for a lot of those names. So the other argument that you could make is in a high interest rate environment, it compresses multiples, and therefore the most expensive stock should have the most multiple compression. I see both sides of the argument personally, so I definitely don't disagree with you. I think that both sides of the argument have some merit to them. From Lath, can you explain what an RDR is? I have a bit of an idea, but I would like your clarification. Sure. An RDR, it stands for Red Dog Reversal. Before Scott Ruther renamed the trade after himself, it was called a 80-20 trade. And some of you guys, which is kind of funny, and I appreciate it in a somewhat sarcastic way, call it a DOO. So if you ever see 80-20 trade or RDR or DOO, they're all the same thing. What it is a counter trend trade that's supposed to take advantage of extension while buying on the way up. If it's a counter trend trade where you're going long because the market's been moving down, or you'd be buying on the way down if it's a counter trend trade and you're shorting because the market's been going up. That is designed to take advantage of extension after some degree of a washout. So basically what you need is, typically, you need to be on at least the third day. Okay, so I just pulled up the IWM because this is an example of it. This is a day 1, this is a day 2, this is a day 3, and the day 1 I would even argue is not a great day 1 because it's not bringing the market down to any degree of extension. It's kind of within the equilibrium area. So you could argue that today was a day 4 for the IWM. You could also make the argument that today was a day 3 for the IWM. But either way, it's a day 3 plus that this trade comes online. It is not, and this is a mistake that people make, you saw one red bar yesterday, and then today it comes back through the previous day's low, and you're looking at an RDR trade. That's not technically what it's supposed to be, even if Scott will sometimes say it is, because then the stock went up. No diss on Scott there. He's great. We go way back. So basically what it is, you get 3 down days in a row here. Well, what happens if you had 3 big down days in a row? Your stock is going to naturally be extended. And extended stocks need to correct through price or time. They can also become more extended. So if on day 4 today, we open up flat and we trade through yesterday's low and we trade down all day, you don't do anything. Maybe the trade's on day 5. Maybe the trade's on day 6. But what the trade actually is when on a day 3 plus, you break the previous day's low intraday and come back through the previous day's low on the way up. And then you buy it through that previous day's low. So in the case of the IWM, yesterday's low is 170.37. So when we break through 130, what did I just say? 170.37. When we break through 170.37 on the downside, we eventually create some sort of low, and you buy it back through 170.37 on the upside with a stop loss as of the day's low at that point, at that time of the day. The idea being you're buying on the way up, you have a potential tail, potential pivot. What is a pivot? A pivot is a spot where buyers are regaining control from sellers for some degree of time. And the idea is that if this then closes well, it closes green on the day, it closes at highs, that you can have a reasonable expectation of getting some upside follow through to at least that equilibrium area of the 8 and 21 EMA. And it is a really good counter trend trade generally. It has all the right principles. You're taking advantage of extension, yet you're not catching a falling knife. You're making sure to buy on the way up. You'll often, because it's a day 3 plus, have a good risk reward versus that low. For example, if you are buying back through 170.37 today with a stop loss at 169.09, you've got $1.20 in risk or whatever, and then your reward profile, your first target on this is really the 80 EMA, which is at this point 174.55. So you're in this case looking at a little over $4 worth of reward potential just to your first target, with a little bit over $1 worth of risk. So that's what the RDR is. I don't think it should be called a red dog reversal. I just think it should be called a red dog retracement, because we don't like to predict reversals on this team because of how low probability they are. Then you can have rules in place for how retracements can become reversals. The only thing I would note is that that's like a big picture trade. A lot of the times what I try to do to trade an RDR is not the textbook way of doing it, which is what I just described. I try to look at the small time frame and find a trade on the small time frame when I already have a thesis that it is this day 4 and that the market should or could RDR for whatever reason, to be able to get a better risk reward by executing on a 5-minute chart or a 15-minute chart on a smaller time frame. So then if we actually close at the end of the day with that RDR pattern like it happened, I have actually a much better risk reward than, for example, this IWM trade, which is risking 1 to potentially make 40 your first target. All of a sudden that could be risking 1 to make 50 because of how small your risk was on the small time frame for the execution. Thanks for the question. Also, what is your preferred method of gauging volatility? Is it VIX, VVIX, UVIXI? I've been using UVIXI as of late, but would be nice to understand how I think of them all. Sure. The VIX is the most important thing, I think, to pay attention to. The actual cash VIX product to look at. I don't pay for index data anymore. I don't trade in indices, and any information that I want to see I can get from a free resource online, or I can get by looking at an ETF equivalent. So I look at the VIX not necessarily for trading patterns. I look at the VIX to see the absolute price of the VIX. And yeah, sure, I want to know if it's trading higher or trading lower. But I, have been trading long enough to know that VIX 13 versus VIX 20 versus VIX 40, what that means from a market environment perspective and what that needs to mean to me for my trading. So I always want to know the absolute value of the VIX itself and the direction in which it's trading. I look at UVIXI as a quick intraday snapshot to have an idea of the VIX's movement. UVIXI is not a product that I want to look at the absolute value of the same way that I want to look at the VIX. UVIXI is not a product that I want to analyze the daily chart of in the same way that I might for the VIX or even the VVIX. Because UVIXI is subject to disgustingly brutal decay, and it only goes down over time. So the degree to which I use UVIXI is to see the small time frame patterns intraday. Pat had some great communication of UVIXI 18 today. That's purely looking at how the VIX is trading intraday by using UVIXI as a tool to see how the VIX itself is actually moving intraday, to get an idea of trading on the small time frame. Finally, VVIX is a leading indicator. So like we pay attention to VIX-VVIX divergences. The VVIX is so the VIX is like the volatility index. I'm not going to get into how it's structured. It's structured based on options. The VVIX is the volatility of the volatility, basically, and it tends to be a leading indicator. And sometimes there are important divergences between VVIX and VIX that we notice, where VVIX tends to lead the VIX a little bit, and those divergences sometimes can be really important trading information for the big picture of the market when they happen. So the answer is I am paying attention to all of them, but I'm paying attention to them in different ways, and those are the ways in which I pay attention to them. So I appreciate the great question. Do you think the market will care, from Bill K, do you think the market will care about Treasury announcing issuance amounts for the next 10 years, next 10 and 30-year auctions, or do I see that as a non-event? So the first piece of my answer is that I haven't overly researched it, and I don't want to give a strong opinion on something that I don't feel I'm qualified enough based on the research that I've done to give you a really strong answer on. I'm leaning to think it as a non-event, just kind of based on what we've seen historically, and how, like, what we've seen with the Treasury. My understanding is that, like, that last government shutdown, not the one that we just barely averted like a day ago, the one before that, and how much money they were going to have to raise on that, and how they ended up, like, I don't remember exactly how they did it, but they really, like, spread out the issuances, if that's the right plural, so that the market could handle a little bit better. And I think that while it wasn't like an event for the market in the way that the CPI is an event for the market, I think it was like a bigger picture thing that helped be supportive to the market. So that's kind of how I would view this also. So whereas my hunch answer, if you will, is that it's a non-event, I should clarify that. I don't think it's an event like how CPI is an event. I think it's an event like, you know, how are they doing this issuance, over what time frame, and therefore how does it affect the market. But, you know, put a big asterisk on everything I just said there, because I'm not researched enough on it. Would also love your opinion on it, Bill, because I feel like you wouldn't ask the question if you didn't have an opinion, but I could be wrong. And the question's appreciated. How do you get to the T3 blog? We have a blog. From Fernando. When an order is triggered and the next day it doesn't follow the expected trend, do you close 100% of the position, or do you maintain a fraction with the initial stop loss? I mean 100% of the position with my initial stop loss. Not even a fraction. I don't change anything with what I do I don't change anything with what I do after I'm already in the trade. And I don't care if all of a sudden the market's not meeting my expectations or we're trending in the wrong way or whatever it is. I don't think I'm good enough of a trader to adjust on the fly and adjust game plans. And I think consistency calls for maintaining the game plan on the trade that you put on when you first put it on. It's too easy to change things in the middle of trades, and I find that to be more reward limiting than risk mitigating. I'll repeat that. I find changing your position outside of your game plan, changing how you trade your position outside of your game plan because you think you see the market doing something different than you expected. I find those changes to be more reward limiting, meaning that you are not enabling yourself to maximize reward, than risk mitigating. Meaning, the idea here is, oh man, I got in this trade, and now the next day the market's trending the wrong direction or whatever. I can mitigate some risk by liquidating the position early. That's true if the trade actually does fail, that you would do that. But I think in the long run, as we trade and as the market moves and as human emotion works, that you will tend to limit reward more than you will limit risk, because you already put on the full risk of the trade. The thing could have gapped all the way down to your stop loss. It could have traded down through your stop loss yesterday. You still took on the risk of losing everything, and you were comfortable with the risk, or you went to put the trade on. But if you're just getting out ahead of time on something you're already comfortable with the risk on because you think you see something, sure, maybe sometimes you save yourself some money, but there's going to be plenty of other times where the trade worked as it was supposed to. It was just a tough morning the next day, but it never triggered your stop loss or anything like that. And now you're not there for the reward on your trading when you really already took all the risk. So that's why I don't change my game, how I trade a trade after I'm already in it. Or at least I shouldn't. Remember, I made that mistake in XLU the other day that cost me because I did change my game plan in the middle of the trade, but we spoke about that. I think that the most important thing for everyone is to be consistent in following their game plans and to stop yourself out of trades at the point where you said, I'm going to stop myself out of the trade, and to maximize reward as it calls for when trades are working out. Thank you for the question, Fernando. From Bill, appreciate the thoughts. I was wondering if you've experienced anything like that before. I haven't, but I don't think we've really seen, at least in my career, Treasury issuance kind of to fund the government like this. And no real opinion, most likely nothing happens, but I could also see it stopping the TLT downtrend. Like you said too, I would imagine it matters. It would be slower flow compared to, I don't know what that means. Oh, like an economic number. Yeah, for sure. Cool. Thanks, Bill. Let's see if we've got anything over on the YouTube. Let me sign on. Bill. Let's see if we've got anything. Let me give myself a thumbs up. Everyone else should give myself that too. Michael B wants to know when I'm going to be leaving for vacation. I am leaving on Sunday. So I'm gone all of the next 2 weeks and that following Monday. And I'm setting it up so that Pat and to some degree Josh should be taking over and doing all the meetings. And they should get broadcasted through YouTube. Everything is normal. Except I will be taking it easy. Lath wants to know where I'm going on safari. Kruger National Park and the private reserve, one of the private reserves just outside of Kruger National Park in the Sabi Sabi area. And then also in Victoria Falls in Zimbabwe. So Kruger National Park, South Africa, and the Victoria Falls area of Zimbabwe. Yeah, super pumped. Super pumped. From Kevin G. What are your thoughts on ever trading futures? I've been finding some real edge in this market, specifically the NQ and how much it moves once you catch the trend. I'd love to hear your thoughts. Sure. So derivatives trading in general, whether it is options or futures, would be something I would find much more attracted to if I was a retail trader. A lot of people that I speak to who trade options or futures, they they're not doing it because they have some specific options or future strategy. They're doing it because there's more bang for your buck because it's a levered product. So the reason why I don't trade futures is I don't need the leverage because I'm a prop trader with T3, and I find futures to be limiting. I find futures to be limiting in the amount of opportunity that's out there. Almost anyone I know, at this point I know some like really, really serious future traders who are deep into that world. This does not apply to them. But almost anyone I know who, like, I don't know, for lack of a better term, is just a trader, and they're trading futures, they're trading the ES, they're trading the NQ, maybe a couple commodities, oil, gold, that's it. They're trading 2 to 5 products at max. So my problem is, sometimes I wake up and I look at the SPY and I'm doing the morning meeting, or the S&P and I'm doing the morning meeting, or the NASDAQ and I'm doing the morning meeting, and I say to the team, I have no advantage in the index today. Well, if I got no advantage in the index today and I'm trading futures and that's all I trade, what am I going to do? Take the day off? That's where being an equity trader has a big benefit, because I've got this universe of several thousand stocks where, sure, the market's in a tough spot, but this company reported earnings, this company got upgraded, this company had news, and I can focus on those names to find edge on that given day. And anything that you can do in the NQ, you should be able to do in the QQQ. They're the exact same thing. The only difference, again, is that the NQ is going to be a naturally levered product, but as a prop trader with T3, we typically start by giving equity traders 20x intraday and 8x overnight. So that totally mitigates the benefit of the NQ. I just take more size in the QQQ trade to make up for it. And at the same time, I could trade Apple today if Apple reported earnings last night. So that's why I prefer just trading stocks. That's why I do it that way. Again, if I was in the retail world, it's very likely that I would be trading options and futures. Yep. All right, cool. A phone trading course. So we don't have mobile access on our trading software, but I'm gonna be bringing a laptop with me for sure. Hopefully this one doesn't get stolen, and I'll be trading from the resorts as much as I can. The market open is gonna be a pain in the ass on the safaris because the market open is gonna be 3:30 in the evening, which I think is right as we're doing our afternoon safari. My middays are going to be free every day, but that'll be before the market even opens. So I'll be able to get my orders out in the same way I do pre-market now. But I do like 85+% of my trading in the first hour of the day every day. I really do. The rest of the day I'm just managing positions. So I love being able to be there for the open, but I'm not gonna trade the open and not say what up to an elephant. You know what I mean? I think that my middays will be lighter, but market's not open yet. Whatever, I'll figure it out. When I'm in Cape Town, I should be able to trade the open a little bit more. What's up, elephant? All right, gang. Looks like I got through everything in the YouTube and everything in the VTF. Have a fantastic night, everybody. Bill, it's so bad, man. I'm trying this week to piece out of things. But I can't go home flat now. Like, oh man, I time my vacation poorly, but you can never time these things properly. If I was going away right at the end of July when I turn more bearish in the market, or even at certain points in August, I would totally have shut off trading. But with where we are right now, we're an 8% correction into this 420 area, into the 200-day, right as we're potentially pivoting out of this window of weakness after this week into the back half of the year where we could see more supportive flow in the market. This is the exact time I feel like I need to be able to be focused on the market. There's a chance that we're getting close. This is what I'm thinking. there's a chance that we're getting close to one of those points in the market that are one of those periods of time where good execution, kind of makes your year. And that's, I know you're not asking a question, but I think that it kind of leads to a question just on trading and profitability. This was very, very true in 2022. It was very, very true in the beginning of 2023. I have found that doing a really good job on certain really key days or periods for the market, like that might last a few days, sets yourself up for a degree of profitability that pays you sometimes for multiple months. And you can't miss those few key days of the year or few key periods of the year. And we had like several of those in 2022. I remember, like and I've admitted this in the past, I did not do a good job on the bear side of the market in 2022, which was a bear market. But I did a really good job on the bear market rallies. Like, we nabbed all those lows, like we called them so well in 2022 by seeing where positioning and sentiment was and seeing how the technicals were beginning to line up and seeing the bigger extension on the downside start to line up with positioning and sentiment to be able to capture these really big bear market rallies. And that was what saved my year in 2022. If it wasn't for that, like, it would not have been a good year for me. So you can't miss those few key pivotal days, and we had them kind of in the beginning of this year also, and the end of May as an example, that set up for continued really good profitability over the course of June, July. Like this April, May, June, July period, I made a boatload of money in that period. But I think it was just because I set myself up well and I positioned myself well in a few key periods of time, followed game plans for reward maximization, and let myself get really paid all throughout this entire move. And then, there was a couple of those key days since then, like that August low or whatever. This one had some potential here on September 27th, but we've also, as you know, that the positioning and sentiment still hasn't lined up perfect for more of those bigger home run-ish type periods that we had in 2022 or the beginning of 2023. And we're finally starting to get, I think, closer to that point. Maybe we're not there yet, but I think we're starting to get closer, where positioning is beginning to move in our direction as we become to a better time of the year, as the technicals have given a standard 8% pullback, but into the 200-day, into really big support. And it's right as, like, everyone seems to be getting a lot more bearish again all of a sudden. That leads me to believe that it could be, over the course of these next couple of weeks, as I'm gone, that opportunity presents itself. And while I certainly don't need to trade 9:30 to 4 to be able to capture those, there needs to be some time in front of the computer if that sets up that way. And I don't want to miss it, because it could pay for this entire trip. And if you've ever tried to do these safaris in Africa, they're really expensive. So it'd be nice if I could pay for my trip on my trip. Have a great night, everybody. See you all tomorrow.